Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join me today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: first up from RNZ on the 2nd of October, new property listings plummet in pre-election lull. Second topic from landlords.co.nz on the 4th of October, flood of new investors unlikely even if government changes. Third topic from New Zealand Herald on the 4th of October, the front page, landlords versus renters, what's at stake in the next election. Ooh, that should be good. Fourth topic, interest.co.nz on the 4th of October, a study by Massey University has found older people need more personal savings than ever to get by. And fifth topic for this week in review from interest.co.nz on the 4th of October, some economists think a national-led government would be more inflationary than Labor. That could be interesting too. So first topic for this week in review from RNZ on the 2nd of October, new property listings plummet in a pre-election lull. The property market is currently experiencing a sharp decline in new property listings, reaching record lows in several regions, as revealed in a recent report. Experts in the industry attribute this trend to what they call a pre-election lull. According to data from realestate.co.nz's September New Zealand property report, numerous regions witnessed a substantial drop in new property listings over the past month. The Coromandel, Gisborne, and West Coast, which have been grappling with adverse weather conditions, saw declines of more than 20% in the last year. Additionally, Waikato, Hawke's Bay, Wellington, Otago, Southland, Central Otago Lakes District, Wairarapa, and Manawatu Whanganui all fell below the typical number of listings for September. Vanessa Williams, a spokesperson for realestate.co.nz, suggests that people may be delaying property transactions until after the upcoming election. This uncertainty surrounding the promises made by political parties has led many Kiwis to prefer a more stable market before making decisions. One notable proposal is from the National Party, which plans to fund a portion of its controversial tax plan through a 15% tax on foreign property buyers for houses valued at over $2 million. This move could potentially generate up to $740 million annually. Foreign buyers have faced restrictions in the New Zealand property market since 2018, a measure implemented by the Labor Party to cool the housing market. Williams points out that even before the 2018 Overseas Investment Amendment Act came into effect, foreign citizens or resident visa holders accounted for only about 3% of property sales. She argues that even if this percentage were to return to its peak levels, it wouldn't significantly impact most New Zealanders due to the small share of the market. Currently, there are nearly 24,000 homes listed for sale on realestate.co.nz, with about 7% priced above $2 million. Williams notes that demand is lower in this higher end segment, with homes above $2 million taking significantly longer to sell compared to properties closer to the national average asking price. While a decrease in property listings is evident across most of the country, some regions have experienced year-on-year growth, including Marlborough, Auckland, Central North Island, and Nelson and Bays. Despite fluctuations in listings, the national average asking price remains relatively stable at $871,400, showing only a marginal 0.1% decrease compared to August. Last month marked the first time since 2007 that the average property price exceeded $500,000 in all 19 regions, with the West Coast seeing a notable 5.4% increase, reaching an average price of $515,183. Williams encourages prospective buyers seeking more affordable housing options to expand their search beyond their immediate vicinity, as there are over 3,200 houses listed for $500,000 or less across the country. Second topic for this week in review from landlords.co.nz on the 4th of October, flood of new investors unlikely even if the government changes. Kelvin Davidson, CoreLogic's chief property economist, suggests that while a national-led government might lead to increased house prices, the impact is expected to be relatively subdued. My personal opinion on this is that regardless of whether we get a change of government or not, I think house prices will continue to increase moving forward. It's a normal stage of the property cycle that we're in. It's not reliant on which political parties in power. Factors contributing to improved housing market confidence include stabilised mortgage rates, high net migration, a robust labour market, and easing credit conditions, which obviously none of that has anything to do with the current government. And yet we're already seeing increasing house prices with the incumbent government in place. So, yeah, I don't expect a change of government or not to have any effect on the property market in that regard. The expectation of National leading the government with property friendly policies could also play a role, but it's unlikely to result in a flood of new investors. For instance, the potential phased reinstatement of mortgage interest deductibility could boost demand, but low rental yields and high mortgage rates still necessitate significant cash investments by new property investors in a lot of cases, making it less attractive, especially for those seeking cash flow. CoreLogic's latest house price index shows that property values across the country remained relatively stable last month, despite a 13.2% decline from the peak in March 2022. Average values remained 24.3% higher than pre-COVID levels in March 2020. Among major centres, Wellington remained flat, while Christchurch and Dunedin saw slight increases of 0.2% each. Auckland recorded a noteworthy 0.4% increase, its first rise since March the previous year. Davidson points out that property values are finding stability and growth, albeit with regional variations. The housing market's patchiness may persist due to ongoing challenges such as high mortgage rates. Looking ahead, Davidson anticipates that property market indicators could remain volatile due to the upcoming general election and potential uncertainty during coalition talks. Heaven forbid. Once election-related disruptions fade, a gradual upward trend in sales and prices is expected. However, this growth may be tempered compared to previous standards due to persistent housing affordability issues, ongoing high mortgage rates, and the possibility of debt-to-income ratio caps at some stage next year. Regarding sales, Barfoot and Thompson reported the second highest number of property sales in 21 months, with median prices remaining stable at $987,000. The agency believes that the housing market is on the path to recovery, particularly for properties priced under $750,000, driven by increased options like apartments and townhouses. Realestate.co.nz's data for September indicates a national average asking price of $871,400 with varying regional trends. The West Coast and Central Otago Lakes District experienced year-on-year increases, while several regions recorded lower new listing numbers compared to typical September figures. Despite these challenges, properties below $500,000 are still available across the country, although buyers seeking affordability may need to explore beyond their local markets. The softer start to spring may be attributed to factors like the election and interest rate rises, dampening the usual influx of listings during this season. Want to learn more about investing in property? Join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. And if you're already a client of ours and you appreciate the work that we do, feel free to recommend us to your family and friends. Third topic from the New Zealand Herald on the 4th of October, the front page, landlords versus renters, what's at stake in the next election? Approximately 600,000 rental properties in New Zealand are currently housing 1.3 million tenants. The future of both of these groups hangs in the balance, does it? As the nation anticipates the outcome of the upcoming election. Anne Gibson, property editor for New Zealand Herald, discusses in the Front Page podcast how the Labour government brought about the most significant rental sector reform in 35 years with the Residential Tenancies Amendment Act. This act notably strengthened the rights of tenants, ensuring that they could feel more secure in their rented homes. It required landlords to provide reasons for eviction and imposed strict criteria for terminations. Both ACT and national parties have made bold promises to roll back some of these Labour-initiated changes. ACT leader David Seymour has even characterised the current system as a war on scapegoated landlords. These parties aim to reinstate no-cause terminations, making it easier for landlords to end tenancies and reduce the bright line test from 10 to 2 years, making the market more appealing to investors. These changes would shift the balance of power back in favour of landlords. Would it? Or would it just make it more balanced? Potentially making conditions more challenging for renters. Would it? Or would it make more rental properties available, which would be better for tenants? This ongoing debate raises concerns about the security of tenants and their properties. Now, this kind of comment drives me nuts, I've got to say, because the removal of that 90-day no-cause termination, I have never met a landlord who evicted a good tenant just because. Okay, the only time that 90-day notice clause was used was to get rid of a problem tenant that you didn't want to have to go through the process of stating the reason why you were evicting them. In some situations, it's just easier to give them a 90-day notice without poking the bear, so to speak. Okay. If you're a good tenant, you look after the place and you treat the house with respect and you treat your landlord with respect, the same way that your landlord should treat you with respect, you really shouldn't have anything to worry about. Landlords like having tenants in their properties because it helps them pay the mortgage. All right. So, yeah, anyway. On the other hand, landlords argue that losing the right to terminate tenancies freely was a rare occurrence, like I just said, and accessing the tenancy tribunal is cumbersome, and especially if you have to prove the reason in some situations. Like, for example, if your tenant, the problematic tenant, is causing issues for the neighbours, like if they're bullying the neighbours or being antisocial, getting neighbours to testify in tenancy tribunal if they're feeling threatened, I mean, give me a break. Who in their right mind would be willing to do that if their next door neighbour was a gang member, for example? And so, yeah, it puts themselves at even further risk. In the midst of this landlord-renter dispute, it's essential to explore what political parties are offering, compare New Zealand's rental laws to those in other countries, and address concerns about the concentration of capital in the property market. So my thoughts on this, and this is just my personal opinion, my thoughts on this is that although the intentions were good, the unintended consequences that these law changes have made have had a dramatically negative effect on tenants and landlords. So I think getting some more balance back into the rental market would be good for everyone. You know, clearly the government can't provide as many rental properties as we need because the private landlords make up the majority of the rental properties that are provided to a third of the population that needs rental properties to live in. Fourth topic for this week in review from interest.co.nz on the 4th of October. A study by Massey University has found older people need more personal savings than ever to get by. Recent research reveals that growing old is becoming increasingly expensive. The study, titled Retirement Expenditure Guidelines, is conducted annually by Massey University's New Zealand Financial Education and Research, or FinEd Centre. It underscores the need for higher retirement savings due to the inadequacies of New Zealand superannuation, or New Zealand super. The research classifies retirement lifestyles into two primary categories: no frills and choices. No frills represents a basic standard of living with minimal or no luxuries, while choices signifies a more comfortable lifestyle, including activities like going to the movies. So not a lavish lifestyle, let's just be clear about that. These categories are further divided into metropolitan and provincial residences, as well as one or two person households. The study shows a widening gap between New Zealand super payments and the cost of living across all of these groups in the past year. Associate Professor Claire Matthews, the report's author, emphasises the importance of considering the evolving economic landscape when planning for retirement. She notes that although inflation has decreased compared to the previous year, it remains higher than recent levels, and the cost of living remains a significant concern. Matthews points out that most New Zealanders aspire to a higher standard of living in retirement than what New Zealand Super can provide alone, emphasising the need for regular reviews of retirement plans. The research indicates that New Zealand Super is insufficient in all scenarios. Let me repeat that. The research indicates that New Zealand Super is insufficient in all scenarios. Even a single person adopting a no-frills lifestyle in a rural area cannot rely solely on the pension, requiring a weekly expense of $689.54 compared to the single-person pension of $496.37 a week. To support this lifestyle with a life expectancy of 90, a retirement fund of $197,000 is needed. For a couple enjoying the choices lifestyle in a major city, the disparity is even more significant. These individuals, often characterised as an active couple in places like Ponsonby who indulge in vacations, theatre trips, and daily lattes, I mean, that's more than a lot of working people have, face a weekly living cost of $1,665.85, far exceeding the couple's pension of $763.64 a week. To fund this lifestyle in retirement, a lump sum of $831,000 is required. This challenge is escalating, with the difference between the pension and actual expenditure increasing from the previous year, ranging from $39.20 to $87.70 a week, depending on the category. All pension rates are based on an M tax code. Matthews underscores that households are increasingly forced to rely on additional income sources or draw down their savings and investments to bridge that growing gap. She identifies key inflationary drivers for superannuitants over the past year, including food, recreation and culture, housing, household utilities, and insurance. Food expenditures account for 12 to 22% of total spending, with a 12.3% increase in the Consumer Price Index, or CPI, for food, more than double the average CPI increase of 6% overall. As a result, food contributes significantly to increased expenditure, comprising 35% to 43% of the total increase. Insurance accounts for 6 to 9% of households' total spending. Last topic for this week in review, topic number 5 from interest.co.nz. On the 4th of October, some economists think our national-led government would be more inflationary than Labour. Goldman Sachs analysts recently cautioned that a government led by the National Party would likely increase mortgage rates more than a Labour-led government. Westpac New Zealand economists also agreed that the opposition party's tax plan could lead to inflation, but saw slightly higher fiscal risks with a Labour coalition. The Reserve Bank chose to maintain the official cash rate at 5.5%, believing its policy was adequately tight to control inflation. Nicola Willis, the National Party's finance spokesperson, blamed Labour for the fastest rise in the official cash rate in history, asserting that New Zealanders couldn't afford another term of big spending, big taxing Labour-led government. However, Goldman Sachs economists Andrew Boak and William Nixon disagreed, suggesting that National's policies might boost property prices and disposable income, potentially leading the Reserve Bank to raise interest rates further. The analysts also noted that Labour's policies appeared marginally stimulatory from a monetary policy perspective, assuming, of course, that they actually stick to their budget for the first time ever since they've been in power since 2017. Anyway, while Willis argued that National planned to spend less overall and offset it with tax cuts, the Goldman Sachs analysts expressed concerns about more stimulative fiscal policy under a National-led government. Local economist Kelly Eckhold of Westpac New Zealand offered a contrasting view, believing that Labour's fiscal plan posed a slightly weaker fiscal position compared to right-leaning parties. He also suggested that National's tax plan might be mildly inflationary by boosting economic demand. Eckhold mentioned that the overall fiscal strategy was likely to be similar, regardless of whether a centre-left or a centre-right government was in power. However, coalition negotiations, particularly with Te Pāti Māori and the Greens, could add pressure to Labour's fiscal plan. Goldman Sachs and UBS analysts agreed that National's policy platform would likely increase house prices, potentially stimulating economic growth through that wealth effect. While this could be inflationary in the short term, it might lead to deflationary effects in the long term if rent prices decrease and rental housing supply increases. Despite differing views on the inflationary impact of these policies, Goldman Sachs maintained its forecast of the official cash rate at 5.5% until mid-2024, regardless of the election outcome. They suggested that if consumption and house prices rebounded strongly due to proposed tax cuts, the Reserve Bank might need to consider holding rates longer or even raising them above 5.5% under a national-led government. As I said earlier, though, I suspect that house prices are going to continue to increase with or without a change of government. It's just where we're at in the property cycle at the moment. After all, house prices have started increasing under a Labour government already. So no reason to think that that's suddenly going to stop if they get re-elected. Both Goldman Sachs and Westpac New Zealand agreed that removing the Reserve Bank's employment mandate would not significantly affect monetary policy. They believed the labour market had always been a consideration for policy decisions with or without a formal mandate. UBS economists disagreed, suggesting that a shift to a single mandate would result in higher mortgage rates and a hawkish stance from the Reserve Bank. Property investments are typically long-term in nature, and property values are influenced by a wide range of factors beyond politics, such as location, demand, supply, and economic conditions. So instead of focusing all your energy on election results, a more productive thing to do would be learning about how to improve your strategy. Join us at one of our upcoming free sessions called How to Succeed with Property Investing. As a seasoned property investor and licensed financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our upcoming events. Alternatively, you can book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website also. That's propertyapprentice.co.nz. Thanks for listening.